Welcome to Chapter 7, where we will be discussing financial assets. So we're going to start off by talking about cash. So at the very least, a company wants enough cash so that it can cover its obligations as they become due. So how much cash is enough cash for any one business? You might get different answers, but at the very least, a company needs to have enough cash to cover its obligations as they become due. A company wants to be liquid because if it's not liquid, that means it can't fulfill these obligations when the due date hits. So to promote liquidity, and especially if a company has enough cash lying around that's over and above what it needs to cover its obligations, some companies will often invest extra cash in short-term, highly liquid securities. So that would be like investing in the stock of another public company, for example. So investing cash instead of having it just lay around not doing anything is more productive. Because why would I want, if I have a lot of excess cash just lying around, why would I want to invest it instead of invest it in safe investments versus it just sitting there? Well, if I invest in highly liquid and safe securities, what can happen as a result of that? Well, I can end up earning a return on my investment. So for example, if I buy Google stock, I have the chance of earning dividend revenue on those shares that I purchased, that I invested in as a company. Also, even if I were to purchase bonds or if I lend money to another entity, I will then earn interest revenue. Now that sounds a little bit better than cash just sitting there. So if I have $100,000 excess cash just sitting there in the bank, it's going to stay at $100,000. It's not going to grow on its own unless I have that cash in an interest-bearing account. But rather, it would be better to take that excess $100,000 and go ahead and invest it in highly liquid securities so that I can earn a return on that cash that was before just sitting idle. Now, this doesn't mean to go and empty your bank account to nothing. Of course, a company wants a little bit of a buffer, but a company never wants so much of an excess of cash that cash, knowing that managers know that cash can actually be used for a better purpose. So you always want a little bit of a buffer, but anything above what a company needs as a buffer of cash should be invested in safe investments so that cash can work for the company and not just sit there being idle. And again, that's also why we've talked about, would I want $1 today or $1 tomorrow? Which is better? Well, I'd rather take $1 today because theoretically I can take that $1 today and invest it and earn a return on that. Whereas if I wait for that $1 tomorrow, I lost out on a potential return. Now, what about financial assets? Because that's the main topic for Chapter 7. So cash is going to be one of our financial assets. So cash is number one on the list. And really it's cash and cash equivalents. They're usually considered to be part of the same category. Another item on the list of financial assets would be marketable securities. And another name for marketable securities would be just short-term investments. And another main item on the list that would qualify as a financial asset would be receivables. So what do all of these have in common that they all fall under the category of financial assets? Well, financial assets in general, it would be cash and any assets that are easily and directly converted into cash. So cash is already cash. It doesn't need to be converted. Cash equivalents are really close to cash. And marketable securities or short-term investments, those can be sold so quickly that they are considered really close to cash as well, because it doesn't take much to sell stock on the open market. And same with receivables, because we've talked about that before. Whether it's an accounts receivable or a notes receivable, both of those will eventually be converted into cash, but when we're talking about receivables, usually accounts receivable is going to be the one that's the most easily and directly converted into cash, although notes receivable would also technically fall under that category. So in sum, financial assets are those assets that can be easily and directly converted into cash, and we'll be looking more closely at each of these three later on in this chapter. So now the question becomes, how do we value those things on the balance sheet? Because we've learned about the cost principle before, where there are certain assets that we have to value at its historical cost on the balance sheet. But that mostly referred to our plant assets, like things like equipment, trucks, buildings, so on and so forth, and even land. But with each of these, it's going to be slightly different. We're going to deviate slightly from the cost principle. Cash is the easiest one, though. How do we value cash on the balance sheet? Well, it's just whatever the face value of the cash is. If there's a $100 bill that we deposit into our bank account, that's $100. That will increase the cash account on the actual balance sheet. Marketable securities, on the other hand, this is a really strong deviation from the cost principle because these types of assets we actually value at current market value. And that's what we'll see on the balance sheet as well. And accounts receivable, also a slight deviation. We value accounts receivable on the balance sheet actually at net realizable value. We'll look at that in more detail, but just the short explanation of net realizable value is that in reality, a company is not going to collect on all of its accounts receivable. In a perfect world, you would collect all the cash that customers owe you, but many companies, it's a fact of life and a part of business to not collect on some accounts receivables. So the net realizable value just is your total gross amount of the accounts receivable minus the expected amount of receivables not to be collected. So the net realizable value is actually how much of the total the company actually expects to collect on. All right, so continue on to video 2 here for a more detailed look at cash equivalents, and we'll start talking about a little bit of internal control as well.